Hello, my name is Jack Elder, Senior Director for Advanced Planning at CBS Brokerage. Today we're going to talk about what I call tax leverage or life in a qualified plan. If you have clients that need permanent coverage, but you're looking for a source for premiums, don't overlook the qualified plan. So I'm going to go through an example today about how that works. So meet Jay. He's an engineer. He views himself as a natural saver and he and his company have been contributing to his profit plan for years. He's 45, he has two kids. He needs life insurance, and he's highly focused on tax efficiency. His earnings put him in the highest marginal tax bracket, which for today, let's just assume it's 50%. He goes to his advisor and says, what do you recommend? And his advisor recommends a Mass Mutual 10 pay, whole life, $50,000 a year. Jay loves it. The cash values grow, the death benefit increases. He loves the safety. He loves the ability to access the cash values to supplement his retirement if he ever needs it. It's a great plan. But he's concerned because in pre-tax dollars, because he's in the 50% bracket, that feels like $100,000 to him. And he asks his advisor if there's a better way to purchase the policy. So his advisor shows him how he could purchase that policy inside his profit sharing plan and use pre-tax dollars for the cost. Jay asks how that would work, and you would designate your beneficiaries to receive the proceeds income tax free if, God forbid, you passed away while you were in the plan. However, in order to preserve that the tax-free nature of the death benefits, you would pick up the economic benefit charges and income, which are pretty small. And so he goes over those numbers with Jay. In year one, it'd be $1,060 of income you'd have to pick up to preserve the tax-free nature of the death benefit. In the 50% bracket, that's only $530 to Jay. Over the next 20 years, the total and the economic benefit costs would be $19,181. Well, Jay loves that. That's a $961,000 swing. I could use $1 million pre-tax, or I could spend 19,000 pre-tax. I like it. But what about plan performance? How will it affect my profit sharing plan? And I understand I can't keep the insurance in the plan once I retire. So how do I get the policy out of the plan? So let's answer those two questions. We're going to start with plan performance. It's easier to illustrate plan performance with an example. So let's assume that the current balance in Jay's plan is 1.4 million, that he and his company are contributing 30,000 a year, and that the plan is returning 6%. And let's see what impact the insurance has on the plan performance. So without the insurance, Jay's plan would grow to $5.6 million. With the insurance, Jay would be losing the 6% compounding on the $50,000 for 10 years. That does have an impact on his plan. However, that impact is mitigated by the fact that the cash values growing within that whole life are also a part of his plan. So Jay's opportunity cost is about $285,000. However, he's still far ahead because he has saved $961,000 outside the plan. And most important, he wants to make sure that his family's got a death benefit. So while the plan's performance is not as strong with the life insurance, the amount he gives up in performance is minuscule compared to the savings. So Jay likes it. Let's get to his next question, which is, how do I get the policy out of the plan? Well, there's generally two ways to do that. You could distribute the plan at retirement when you're in a lower income tax bracket, or if you have a trust, that trust could purchase it from the plan in an arm's length transaction. Let's go through each one of those options. So most retirees can assume that they're in a lower income tax bracket when they retire. However, for today's purposes, let's assume Jay's still in the 50% bracket. When Jay retires, there's forecasted to be $895,000 of cash value in that policy. In actuality, when a life insurance policy is distributed from a qualified plan, you need to get that policy valued at that time. But for whole life, you can approximate the value as the cash value. So in practice, we would go get a valuation from the life insurance company. But for today's example, let's assume that the cash value is a good approximation of the fair market value, which in whole life it would be. So when Jay retires, if that policy is distributed to him, the fair market value, i.e. the cash value at that time, would be right around $895,000. Assuming Jay's in the 50% tax bracket, which is unlikely, chances are he'd be in a lower income tax bracket, he could pull cash value from the life insurance policy to cover the taxes. As you can see, the taxes would be about $440,000 and change. There's ample cash value to cover that. If Jay were in a lower income tax bracket, and he likely would be at retirement, the cost of the taxes would drop precipitously. For example, if Jay, who lives in New Jersey, retired to Florida and his income put him in the 20% bracket, it would only cost him $180,000 to roll out. So even under a high tax environment, this is a very good deal for Jay, and he wants to proceed. So before talking about how a trust could purchase the policy, let's go over the math one more time. The imputed income is $19,000 over the course of 20 years. Jay's going to pick that up. That's going to be his cost to have the policy owned in the plan. As we discussed, the opportunity cost on that 6% compounding is $285,000. So the total cost to Jay is $304,000. Compare that to using pre-tax dollars, tax-affected dollars, a million minus 304,000. Jay views this very accurately as $700,000 in savings. And what does he get for that? Well, at age 90, the death benefit would grow to $2.2 million. And the cash value would be almost $2 million. He could access that to supplement his lifestyle. That death benefit could be there to take care of his kids. It's a great plan. He really loves it. Now we need to talk about how we're going to get the insurance out of the plan. Well, if there's an existing trust that's already been funded, that's the ideal solution. But if there isn't an existing trust, at inception, when Jay purchased the policy, he could begin funding one. So let's look at how both of those would work. The Holy Grail would be an already existing trust that's fully funded, that could purchase that policy for its cash value, around $895,000. Alternatively, at inception, Jay could begin making gifts to a trust that are invested, let's assume at 6%, just like his qualified plan. The trust assets would grow to 974,000, which is more than the cash value in the whole life. At that time, there's enough cash in the trust to purchase that policy for its fair market value, so that after the transaction, the profit sharing plan would have the cash to invest, and the trust would have a life insurance policy outside the estate. So Jay asks, why wouldn't every client do this plan? It's such a good idea. And here are the reasons. Number one, the advisor never showed it to their client. But those that have considered the plan may not like it because they're concerned that the insurance contributions would subtract from the accumulated value in the qualified plan, which is true. But as you could see from previous slides, the plan performance slides, even if the plan loses that opportunity, that 6% opportunity cost, the overall savings still outweigh that cost. Another reason clients don't do this is because you can't do it in an IRA. An IRA is probably the most common type of retirement plan. You can't do it in an IRA. There's some rules called the incidental benefit rules that need to be observed, which essentially limit the amount a qualified plan can spend on insurance. I'm using in this example a profit sharing plan because the rules are most liberal there. But if you have clients that have rollover funds, you could roll them over into a profit sharing plan and do this transaction. And then finally, the qualified plan document has to allow for the purchase of life insurance. So who's the ideal client? Well, business owners and executives with a profit sharing plan that need permanent protection for either tax-free income or wealth transfer. These clients are generally going to be concerned about the pre-tax cost of coverage, and you, as an advisor, are going to be looking for a pool of funds that can be used for premiums. There's no age requirement, but generally speaking, this client has to have seasoned money in their qualified plan. Therefore, they're going to probably be in their 40s, maybe late 30s, but 40s, 50s. And most of the clients that would get the biggest bang for the buck can expect to be in a lower marginal tax bracket at retirement. So there are some T's to cross and I's to dot, and we can help you with that. But the key is here that if you have clients that are that need permanent protection, that have a source of funds in their qualified plan, don't overlook those. And we can help you structure the plan, work with the carrier, review the plan documents to make sure life insurance is a suitable asset within that plan. We can help you from the very beginning to the very end. Do not overlook the opportunity to use qualified plan dollars for your clients.